So as you can tell, I am neither Royal nor James. I am filling in for them today. My name is Avery Martin, and like them, I am also a financial advisor. But for today, our topic's about Social Security and kind of just demystifying a little bit, and just a little bit of planning and looking at it since I'm not exactly sure your age, but with it being closer to 62, 65, 7, just people have questions about Social Security and when they should be taking it. So let's get on started. So with Social Security, most people tend to minimize the value of it. They understand they've been putting into the system all their life, and then at some point they're expected to get something out of it. But with that, though, Social Security is one of the more valuable things you can look at. The first reason is that Social Security is one of the few sources of income that you can't outlive. I mean, there is some argument made, there's some when they've talked about cuts and everything, but it's designed to provide you income for the rest of your life. And so, of course, as you live longer, you'll extract more and more of the benefits out of that system. And in a similar sense, if you don't live as long, then you won't get as much benefits. So, for example, if your benefit starts out at 2,000 per month, and if you live for 10 more years, you'll receive nearly about 300,000 in benefits over your entire lifetime. If you live 20 years, this goes up to closer to 600,000, and then if you live 30 years, it jumps up about to a million over the course of those 30 years. This does assume that you do get a cost of living adjustment of 2% each year, which historically speaking is relatively about what it is. So the second, like we just talked about, the second other thing with Social Security is that it usually offers an annual inflation adjustment. So say your benefit does start at 2,000 per month. If the annual COLA or the cost of living adjustment, if it's 2%, in 10 years you'll be receiving about 2,500 per month. And then after another 10 years from all those adjustments, you'll be about 3,000. And then in 30 years, you'll be at about 3,600. Again, this not to say that those are guaranteed, those COLAs, but they seem to be about 2% each year. Sometimes they'll be 3%, sometimes they'll be a little less, but 2% seems to be about the average, or at least a good estimate of how it works. So when you look at Social Security, how it's calculated, it's based on how much you've earned over your working career and at the age at which you apply for benefits. And so with those two factors in mind, there's a formula that they use, and it gets pretty complex. It's not too complicated, but it does get some complexity to it depending on your situation. And so the general process goes like this. First, Social Security looks at your annual earnings over your entire lifetime. It then indexes it for inflation and picks the 35 highest years of earning to include in that formula. The index earnings are totaled and divided by 35 to come up with an average. If you don't have 35 years of earnings, then those missing years will be filled in with zeros, which will effectively reduce that averaged amount and your benefit. Next, they then have a formula that's applied to your average index monthly earnings, and it's used to determine the primary insurance amount of your Social Security, which is then the amount that you'll receive at full retirement age, which we'll talk about here in a little bit, what exactly full retirement age means. Each year, annual COLAs are applied to your benefit to help keep up with the cost of living. In the last few years, they haven't really kept up with inflation, but some years they'll be there, mainly there to keep up with inflation. But the last few years, like I said, they haven't. So let's look at an example of the benefit formula. So say you were born in 1964 and you earn the max Social Security maximum every year since the age of 22. The average index monthly earnings would work out to be about 14,300. And in calculating the primary insurance amount of Social Security, the first 1,200 or 1,286 gets multiplied by a factor of 0.9. The next amount between the 1,286 and the 7,748 or $6,463 gets multiplied by a factor of 0.32. Then it'll get another step down, which then between the amounts after the 6,000 or after 7,749, those get multiplied by 0.15. And so in there, you can see on the screen, there's a bit of a breakdown. It does, like I said, it gets a little complicated, but it's just it's kind of similar to income tax on how it's factored in. So the fortunate thing is that you don't have to do this formula yourself to figure out what your actual benefits are. But first, let me take a step back. And like I said, with the full retirement age, it depends on the year you were born. And so it used to be 65 for everyone, but then they started to phase it up in 1983. So for everyone born between 1943 and 1954, the full retirement wage is 66. And then from 1960 and later, the full retirement age is 67. For those born between 1955 and 59, there's a gradual step up in months as it got phased out. So like I said, with the retirement age, this depends on when you were born. Um, so looking back, so with that, with being at the full retirement age, you can take your benefits earlier. Um, and so if you do, though, that you get a multiple or a factor of it. And so in this scenario, say your retirement age, full retirement age is 67, you can take it at 62, but you'll be locked in at 70% of that value for the rest of your life. And otherwise, and that can each month that 70% goes up a little bit, and they have it kind of where there's different ages of a set amount, but it's a prorated amount per month. Now, if you wait till after your full retirement age, that factor actually goes up by 8% each year. So in this case, if you wait till 70 and your full retirement age was 67, you'd get 124% of that benefit. So, and so going back to how I mentioned, you don't necessarily have to calculate that formula for yourself. The Social Security, the government and the Social Security office, they have that information. And so what you want to do is you could go to one of these links on screen and you'd be able to find out what your estimated amount is. And so the one way you can do this is you can refer to your annual Social Security statement, and these are at the first one. If you create an account on the Social Security website and go into your account, you'll be able to see what that statement is as an estimate. The next, you can use the retirement estimator on the Social Security account. This calculator taps into your specific earnings history after you've entered your personal identification information, including your birth date, Social Security number, and your mother's maiden name. Since it's the government, they have all that stuff, but they're just trying to check, and it's a relatively secure site. So, and like I said, it's a governmental site, so they keep it secure. Um, Please note that the annual statement and the retirement estimator do not factor the COLAs in. And so when you look at your age 70 benefit, it's likely in reality, if you waited longer, that that benefit would actually be greater than what you look at it right now. So there is just a little bit of mismatch of them not factoring in that 2% or 3% or however it is throughout you would actually get in reality, but it's just something to note that your estimate might be a little bit lower than what you actually get. So if you go on to that final one, that final link, you're able to use all the different benefit calculators and play around with it, and just see the different things that the government has set up to be able to see what your Social Security estimate might be. So you might look at this and see that if you waited longer, you'd get more of a benefit, which is true, but it doesn't necessarily mean you should wait. There's many different factors, as on the screens. Look at your health status. If you're sick, you might want to take it earlier. If you're life expectancy, maybe look at your family history and people in your family only live to 75. Well, then looking at that, you might want to look and say, hey, I want to take it earlier. That way I might pass away before I can even get any of the money I put into it. Another one is maybe you retire and there's a need for income. It's kind of one of those things. It's like if you need it, you need it, and so you should take it. Um, Last one is kind of looking at your surviving spouse. And so there's different factors in there depending on if you're married or not, that if one of the spouses passes away and they make a higher amount, it does kind of get passed on to that the younger spouse or the less earning spouse on the Social Security side. So there's just all these different factors that make it so that's not exactly that you should wait till 70 or take it at full retirement age. And so it's just kind of a personal decision. And so looking at that, it does provide a pretty complex question because it's all specific to you as an individual. Um, so like we mentioned, a few things to remember, if you apply early, your benefit starts out at some fraction of your full retirement age benefits. It could be the 75%, 80%, 90%. It just depends on when you do it before for full retirement or even afterwards. And that percentage, it's docks it down or increases it for the rest of your life. It doesn't go back up to 100% if once you reach full retirement. Say your full retirement age is 67, you take it at 62, you get the 70%. Once you hit 67, it's still the 70%. And so with that, it's things to consider is those COLAs. They magnify the impact of them when you delay. Because since it's a percentage, if you delay and your payment is more, that percentage will increase that more than if you took it earlier at a lower amount. For example, it's like saying 10% of 1,000 would be 100, where 10% of 900 would be 90. And so there's just that more increase of an extra 10 there that signifies that. Another one is that the when to apply question impacts survivor benefits, as well as high earning spouses are therefore encouraged to delay benefits to age 70. This was what I was talking about a little bit earlier, because when they pass away, that higher benefit will get passed on to the surviving spouse. And so it's just one of those things that you want to be keeping in mind as you look at it and taking in both spouses if you're married. Next, we'll look at some of the strategies. I think there's about 5 of them. The first thing you can do while you still have time is just to improve your earnings record. I mean, it's easier said than done if you're in a certain career path or job as you've gotten older, but it's just one of those that if you can earn more because it will increase that average amount of your benefits. And so with this, it's important to go on to the Social Security website and just check if it's accurate. I mean, you would hope it is, but of course, if the government's keeping track of everyone and there's millions of Americans, that there's a chance that someone's gets messed up. And so we want to make sure it's not you. So like I mentioned, with the earning more, sometimes you can't earn more, but what you can do is work a little bit longer. So if you have some years where in the calculation you have zero earnings, if you work a few more years, those zero earnings go away, and so that will theoretically increase your benefits. Especially when it tends to be at the end of your career, you tend to be at your highest earning years, and so it helped to get some of those lower ends out. Another thing to think about is that you can start receiving Social Security and still work. There is some technicalities to it and some specifics, but it is something you can do where you can still work, but just know that every dollar after you make it's 21,240 is the threshold. Any dollar after that, or every $2 after that, excuse me, every $2 after that will reduce $1 of your benefit for that year. And so that's not to say that that benefit goes away just because you're working. It gets recalculated after you hit full retirement age. So second strategy for max is to maximize your benefits at the optimal time. Um, with that, we're making the case today for delaying your benefits, as I was talking about earlier, just because it's not best to delay just because it pays you the more. So it's looking at the taking your benefits at the optimal time and optimizing it for your situation. So in the example, you could be that you both need income right now and in the future. So it's kind of one of those that you have to take. Um, yeah. So it's like I said, it's not a one size all fits all. It's just a what is important to you and all those other factors we talked about a little bit earlier and optimizing for your situation. So with that, like I mentioned, one important consideration in deciding when to apply for benefits is whether or not you plan to continue working into retirement. If you applied before you turn full retirement age and you earn more than 2004 or 24,480 in 2026, every $1 of every benefit will be withheld for every $2 you earn over that amount. So it's important to know that this money isn't taken away from you, like I mentioned, but it's rather your benefit will be adjusted upward when you turn full retirement age to make it as if you had applied later. So you get some of the benefits, they adjust out how much you've gotten, and then they go back in once you hit full retirement age and recalculate everything to go and decide on your new benefit. So Um, so that's just one thing. So it's don't let the annual earnings test discourage you from working while you're taking your Social Security or in your retirement. It's just knowing that there is some of it will be pushed back into the system for a bit before until you hit the full retirement age. So then once you do hit full retirement age, that adjustment will be made and everything will look at it, and you'll end up with a higher benefit for the rest of your life. And then, of course, one way to just avoid that retirement earnings test is just to wait until your full retirement age. Mm. The third strategy for maximizing your benefits is to coordinate spousal benefits. And so this is what I was talking about a little bit earlier, is to maximize the income for both you and your spouse while you are alive and maximize the income for the survivor after one of the spouses passes away. It can be quite complicated, but by understanding all of the considerations and doing some calculations, it is possible for married couples to come up with the right solution for their needs. And with this, the general framework is looking at the spouse who has the higher benefits and maybe if seeing if they can push their benefits longer and holding them off until they're 67, 70. That way, in the case if they pass away, then those benefits can be passed on to the surviving spouse. So fourth strategy is just about minimizing taxation of benefits. So a lot of people don't realize this, that your Social Security is subject to tax, which isn't to say that it is going to be taxed. There's different thresholds. So I guess I'll move on. There's different thresholds to where your Social Security becomes subject to tax. And the first one is that 50% of your Social Security be subject depending on how much income you have. I believe it's around 15,000. And then once you get up to about 34,000, I believe, up to 85% is subject to tax. That's one of those things that people don't really realize when they have money coming in from their IRAs or they're in different muni bonds or municipal bonds and other income producing assets, or they're working still, that if you make over a certain amount, your Social Security becomes subject to tax. And another comment on that too is that the max is that 85% is subject to tax and doesn't mean it will get taxed, but it's subject to it. And so there is 15% of it that is never subject to tax. So there's some strategies you can do before you take your benefits or before you get into RMD age which are required minimum distributions from your IRA, that you can start doing some things beforehand to reduce your benefits from being taxed or subject to tax. Um, so one of the interesting things too here is if you have someone or you get into municipal bonds, they may be non-taxable on when you file your income taxes, but in the case of looking at Social Security benefits, they do get that income does get factored in. So that's just something to be aware of if you have a bunch of municipal bonds thinking that you won't be subject to this tax. It unfortunately gets put in there. And that has another semi-complicated, complex formula, but it's something that your CPA or tax professional will be able to help you and um, let you know why some of it's subject to tax. Uh, Another way we can do this, if you start, is to start converting some of your IRA, traditional IRA, which is pre-tax, into a Roth before you become of age. It's either 73 or 75, depending on your age of when you have to start taking money out of that. And so if you start doing some Roth conversions, you pay the tax earlier in your life to then never pay tax on that money again. So that's just something to consider with doing that. There's some games to play with between the tax brackets, and it's called a Roth conversion. So another strategy is just to delay the Social Security if you can, and in order to reduce the number of years benefits are subject to tax. So you could look to reduce your expenses, pay down some debt, and adopt a simpler lifestyle so you could make do with less income. So it's just an important thing to consider that as you continue through your retirement, that taxes are a concern and it's just something to be managed. And it's, of course, always consult your tax advisor, your CPA, your EA, whoever does your taxes, or someone who professionally does do taxes. That way they can help you throughout this process and make sure it's done correctly. The final strategy is just coordinating your Social Security with your overall retirement income plan. And so with this, it's important to consider Social Security in the context of your other retirement resources, including pensions, IRAs, and 401ks. So with that required minimum distributions, your overall investment portfolio, and your plans for working in retirement. So it's kind of getting that idea of taking it in context with everything, not just looking at it from if I delay or if I take it earlier, um, will I get more money kind of thing. It's really important to look at it from a whole view and see where your incomes are coming from. And so with that, it's you shouldn't be afraid to ask for help with someone looking at all that as a professional, either your tax person or a financial advisor such as myself. Um, because it's retirement planning is easy when it's a matter of just stashing part of your salary into a 401k or an IRA. But when it comes time to actually start taking money from all these different places that you've put it and hopefully have let it grown and got ready for retirement, it gets kind of complicated and different ways it can become complex and certain pitfalls or situations might cause you're like, oh, I didn't know that was going to cause me to get, like in this case, my Social Security benefits taxed. So it's just important to have someone look at it, or if you're comfortable with it yourself, just making sure you look at it from the context of everything. Because it's really when you boil it down, especially in the case of now with retirement, the Social Security is a bedrock of your plan. It's a guaranteed, like we mentioned at the very beginning, it's a guaranteed income source that theoretically will get paid out until you pass away. And so it's the very foundation of it before you start looking at how to take income from everywhere else. Because um, like we said, once you make that decision on when to take it, that's your decision for the rest of your life. And with that, we come to the end of the presentation. So if you have questions, similar to like if it's on screen or everything, if you have questions, feel free to be happy to answer them individually um, in a one-to-one meeting, or feel free to email us at our office, uh, which is on here. If you want to email those questions over or call in, happy to set up a time to talk with you and answer any questions you have and look at your situation personally.